Welcome to Sand Compounding. This is Sandeep Anand. Today we will learn a lot of investing wisdom from the global Canadian-based investor billionaire. His name is Prem Watsa. He's called the Warren Buffett of Canada. And Prem Watsa is a very astute investor, and he has created immense wealth for his unit holders of his fund called Fairfax Holdings. Fairfax Holdings is a global investment firm, and now Prem Watsa is extremely bullish on India as an investment opportunity. They have gone ahead and listed, in fact, the Fairfax India, which is focused on investing purely in Indian-based companies. Here are some investing wisdom which we can gain from Prem Watsa. Take a look.
I worked for a life insurance company for 9 years before taking control of a small insurance company, 1985, 31 and a half years ago. I didn't have any money, as I said, but people backed us. In a couple of years, we changed the name of our company after a couple of years to Fair Friendly Acquisition. Fair Friendly Acquisition AX Fairfax. That's where we got the name from. One of my secretaries came up with the name. Tried the board of directors, it didn't work. Secretary came out with the name. We had revenues when we began of 10 million. 31 years later, we have revenues of 10 billion. Investment portfolios of 24 million. We have 30 billion today. Our capital in the company was 10 million. It's 10 billion today, and our stock price was 3.25, and it's now 650. We've compounded the stock price at about 20% a year for 31 years. There's only about 10 companies among the big companies in the United States that have done that. We had less than 50 employees. We have 22,000 employees in our insurance business, and we control restaurants in Canada, and we have 50,000 employees. So why? I was fortunate. I don't consider myself any smarter, brighter, whatever. I was fortunate to go to a country which is business friendly, which allowed you to do these things. Our own company, if I can take 2 minutes, we've got a wonderful culture. Our culture is based upon providing outstanding service to our customers, looking after the people who provide that service, making a return, being profitable, and then putting money back into the community we did business. So when we began, the whole company was worth $2 million. In the last few years, we've invested $15 to $20 million each year in the communities we do business. So we've prospered mightily, and I just wanted to highlight 2 or 3 guiding principles that we have followed all these years, and it might be useful for you. Everything we've done is long-term. We focused on the long term. You build a business over time. You don't build it over 3 months, 6 months, a year. You build it over time. And that's what we've done. We have an odd principle. We say we work very hard, but we don't want to work at the expense of our families. We put families right up at the top. And we have believed that teams work really well. So we're very team-oriented, and we are fearful of people who have big egos and are arrogant. So President Ronald Reagan made this statement years ago that anything in the world is possible, anything in the world is possible, if you don't care who gets the credit. If you don't care if it's your idea, my idea, as long as it's good for the company, you should do it. And we try to follow that.
In 1999 and 2000, 1998, 99, we bought 2 big companies in the United States. And it took forever to turn them around. They were turnarounds. Took forever to turn them around. So we thought we'd turn them around in 2 or 3 years, right? We have a combined ratio that we have to, it's a metric that you look at for the property casualty business. And we were focused on getting that done. Took us more like 5 and 6 years. So Crum & Foster was a company we bought in 98. And I remember our shareholders, quite a few in the United States, one lady said to me, Prem, you made 3 years after 98, so about 2001, exactly 2001, 2002. She said, you made a mistake, right? Why don't you just admit you made a mistake? You bought a company, you bought a lot of good companies, she said, but this one was a mistake. And I said, you may be right, but it's like a baseball game. There's 9 innings. After the 3rd innings, you haven't lost the game, or 4th innings, right? So here's what happened in that company today, right? Crum & Foster. We paid $680 million for that. And it's an example of long-term, focusing on the long term. We paid $680 million in 1998. By the end of 2010, we had dividends of $1.5 billion, and the company still has, in the company, $1.2 billion of statutory capital, right? So 680, 1.2, after we've taken 1.5 billion. So, but it took us a long time. It took us forever to turn it around. But we just focused on it, worked hard. People who turned it around were outstanding. We had some really good people who worked in that company. And so we just took a longer time. And so our view has always been in our company, we don't give any guidance, no guidance. Business is a long-term deal. Who knows what will happen in 3 months or 6 months or a year? So we say, if you're a shareholder of us, you're thinking long-term, because we really don't know how to do well in 3 months or 6 months. So our company is not run in a 1-year basis or 2-year basis, right? So we take it over long term. Over the long term, we have compounded. We started with a book value per share of $1.50 US, $1.50 US, or $2 Canadian. And our book value today is about, at the end of September was $400. So that's a compound growth rate of 25%. But there were many time periods during that time period where a compound rate would have been 3 or 4%. But long term, put it all together, it's a pretty good rate.